Hello and welcome to episode number 11 of Prosperity by the Pint. I'm your host, Brice Carter, self-proclaimed millennial money expert. I've earned the CFP credentials, chartered financial consultant as well, and I'm a certified investment management analyst. This is a podcast where we talk about money, investing, business, and life success, all while having a cold beer. This episode, we will be talking about Investing 101, Mutual Funds and ETFs. This is a follow-up to episode number 6, Investing 101 Stocks. So I have to say, we forgot to celebrate something with my podcast team, is that the average finance-related podcast only lasts 9 episodes, and here we are at episode number 11. So my team is here, so round of applause. It's not possible without them, so shout out. Thank you, Allie, and everybody else that helps. So this week I am drinking from Wild Leap Brewing Company, which is out of Georgia somewhere, LaGrange, Georgia. Wild Leap Brewing Company, Alpha Abstraction Double IPA. It's a 8% double IPA. It's got a buffalo on it, which is weird, but I have my Surf Wyoming shirt, which has a buffalo on it, so it goes together. So the Alpha Destruction IPA, let's try this. Ooh, it's got a lot of things going on. It's an IPA, but it's hoppy, but I don't know, a little bit of fruit in there too, maybe grapefruit. Really good. I like it. I don't like that it's not clear. I like my beers to be clear. I don't know what's in there, So, like I said, this is a follow-up to episode 6, which was all about stock investing. So if you haven't listened to that episode, you should go back and listen to it. But here's the 411 on that is if you're listening to this, you are not a day trader. You are not smarter than the market. You probably should not own or be buying or investing your future in individual stocks. Now, if you want to have a small subset of money for playing, that's okay. But when it comes to investing for your long-term future, you are not a day trader. You're not smarter than the market. Don't do it. So here's our alternative, mutual funds and ETFs. So I want to talk a little bit first. I'm going to talk about mutual funds first, and I'll get into ETFs. Like, what is a mutual fund? Okay. And a lot of people are confused about this. So a mutual fund is an investment vehicle that essentially pools your money, with a bunch of other people's money, in order to get broader diversification. For example, let's say you have $1,000 to start investing, and you happen to tech companies. They always say you should buy what you know, and if you maybe know and like tech, that's fine. So you want to buy Amazon or Google. Well, guess what? A share of Amazon and a share of Google, both of them are over $1,000 as of the filming of this episode. So you can't even buy one share of those two companies with your $1,000. So if you're investing in a mutual fund, let's say you bought a mutual fund that invests in tech companies specifically, you could own Amazon and Facebook and Google and Apple and dozens of other technology companies and be very well diversified in that area with a relatively small investment. So a mutual fund is an investment vehicle that pools your money together with a bunch of other people's money so smaller investors can get diversification. So, fun fact, the first modern-day mutual fund was launched in 1924 by what is now known as MFS Investment Management. It's still a huge mutual fund company. And it was launched in 1924, and following that, the launch of that, it was not long after that you had the Great Depression, and this particular mutual fund company and several others started launching them all through 1924 and 1925, and they were really growing, but a lot of them have since closed, as you can imagine. So almost 100 years now we've seen modern-day mutual funds at work, and they've worked well for a lot of people during that time frame. So the way that a mutual fund works, how you buy one, beer break. This is good. It is a dirty beer, but it's good. By dirty, I mean small. Also, fun fact, I do a little brewing myself, and if you can't see through it, I usually don't drink it, but you never know when it's in a can. But still, these were sent to me by a friend that lives in Georgia, so thank you, JT, if you're listening. So when we're looking at mutual funds and how they trade, so stocks, when you buy a stock, you're typically buying it from another investor on an exchange or from on a brokerage, type of platform. where investors are literally trading shares or trading money for shares. A mutual fund works a little bit differently. So shares are issued and redeemed from typically the mutual fund company. Sometimes it can be a brokerage. So shares are issued and redeemed. Now, what that means is that there's a value to each share. That is because these companies aren't one single company, right? So a mutual fund company could own thousands of other companies, and it owns tens of thousands of shares of perhaps some of these companies. So every single day at the end of close of business, the value of all the companies that a mutual fund owns is added up and divided by the number of shares. So that's where you get what's called the share price, or that NAV, net asset value. So you buy, and when you buy a fund, you're buying it from the mutual fund company, and when you sell it, you're redeeming that share to them. So then they exchange your share for some cash. So they don't trade in the middle of the day. You don't know whether a mutual fund is up or down in a given day until the close of business. Typically 6 p.m. is when it's calculated. So with a mutual fund, the big advantage is the broader diversification. One downside is that you don't know whether it's up or down in a given day. Now, if the whole market's up, odds are you're up, but you don't know exactly what that looks like. So there's two basic types of strategies with mutual funds. And it gets more complicated than this, but there's two basic types of mutual funds, I would say. There is passive funds and there's active funds. So an active fund is a fund that says, okay, my category, let's just call it large cap U.S. companies, which is just large U.S. companies. We're going to try and find the best U.S. large companies, the ones that are going to have the best stock performance, right? So you're paying that active manager, if there's 1,000 U.S. large companies, to only buy maybe 350 of them, that they think the stock performance is going to be the best for you. And they charge a premium price for that work, that research, all those things that they're doing to try and beat their benchmark. A passive fund just says, screw it, we're going to buy all 1,000 companies and we're going to hold them according to their size or according to an algorithm. Okay, so a passive fund just buys the market blindly. It's called the haystack strategy. That's what I call it anyways. So you're not trying to find the needle in the haystack. You just say, screw it, let's buy the whole damn haystack, right? Whereas a more active strategy might say, well, we're going to take this corner of the haystack and this corner of the haystack and this corner of the haystack because we think the needle's in there somewhere, right? So that's the difference. So you pay a little bit of a premium on the active funds for them to try and beat the market for you. The passive funds are much less expensive. The fun thing is, I don't know about it necessarily fun, but the interesting thing is that depending on whose research you listen to, only 10 to 20% of active funds actually beat their benchmark. So you're paying additional fees in order to lose to the benchmark. Then that's what that works out to be, is you're paying them an additional fee. And if they're not beating the benchmark, that means they're losing to it, right? So you're paying extra fees in order for them to beat the benchmark. Now, I don't think all active funds are bad. I just think you got to be very conscientious of the fact, 10 to 20%. So if we're looking at, let's say, the U.S. large cap space, by the way, there's about 8,000 mutual funds. So there's a lot to choose from. And that's according to Morningstar. There's about 8,000 mutual funds. Maybe 1,000 of them invest specifically in U.S. large cap companies. So if we're talking 10 to 20%, that's 100 to 200 fund companies that are statistically better than the others. That's enough to pick from, right? Most people shouldn't be trying to play that game, in my opinion. So of the passive funds, you can save on fees a little bit and you just buy the whole damn market. Now, a mutual fund usually, in addition to either being active or passive, is either a stock mutual fund or a bond mutual fund. There is balanced ones that own a little bit of both. What that works out to be is a stock one says, we're going to buy all large cap U.S. stocks or mid cap or emerging market or whatever. A bond mutual fund is just going to buy bonds. So they're going to buy maybe government bonds or corporate bonds. So you're picking between active and passive. You're also picking between stocks and bonds. And what you're looking at here is a scenario where we're essentially building out a asset allocation. So as I say this, I'm really thinking I'm probably going to need to do an episode on asset allocation and what that is, because I'm laying some foundational work here on why you shouldn't probably be investing in individual stocks with your life savings, but you probably should be using mutual funds or ETFs. But how do you go about picking those mutual funds and ETFs? So I'm curious if there's some interest on that topic of building an asset allocation. Shoot me a message on the Facebook page if that's something that you are interested in hearing about. So, and that's Prosperity by the Pint, by the way, if you don't have that already. So you have passive active, you have stocks or bond mutual funds, and then some get really granular in a sector. Like I mentioned, you can have a mutual fund that specializes in technology or industrials or aerospace. I mean, there's all kinds of stuff out there. So there's a lot of different really things to think about. Now, for most of us investors, most people that I see investing in mutual funds are looking at it through their 401k, which you're working with a pretty short list there typically. So what I want to say with that is that it's very important to make sure you know what the cost that you're buying, the cost of the fund, and also what it's actually investing in, and make sure your risk is tilted the correct way. I want to circle back to ETFs for a second. So I talked all about mutual funds up to this point. I want to talk about ETFs. ETFs are kind of like, I don't know, they're the stepbrother of mutual funds and the first cousin of stocks. The reason I say that is they work like mutual funds. It's an investment company that pools your money with other people's money for broader diversification, but they trade like stocks. You can buy and sell them on an exchange. You're buying and selling from other investors, and they trade in the middle of the day. You know how much it's up or how much it's down in the middle of the day. Now, ETFs are babies when it comes to age. So mutual funds have been out 1924. The first ETF, which again stands for Exchange Traded Fund, was only launched in 1993 by State Street Global Investors, and it was the first one was called the Spider S&P 500 Fund. Most people know it by its nickname, or its ticker, which is SPY, SPY. It's still to this day the biggest ETF in the world, and I want to say it changed the investing landscape, more so even than the invention of the mutual fund. And the reason being is it made investing in ETFs, investing in the market, lower cost. So the SPY, I think it's like 0.07% to invest in. So buy the whole S&P 500 for 0.07%. Now, don't quote me on that. I'm just roughly what it costs. So ETFs work similar to mutual funds in the sense that they're investing in a broad basket of securities. It's not one stock, but they trade much more like individual stocks. Beer break. So the cool part about ETFs is that they tend to be a lot less expensive than mutual funds. So most of them are passive vehicles. There are some active ones. Most of them are passive vehicles which track an index, and they do it for a lower cost. So if you look at Vanguard, for example, is probably the biggest mutual fund company in the world. And they have mutual funds and ETFs that invest in the exact same thing. And on most of those, the ETF version is less expensive and has no minimum, whereas even, the mutual fund, if it costs the same amount, you have to have $1 million in it to pay that low expense ratio. So ETFs tend to cost less to invest in the same marketplaces. They have lower transaction costs. So an institutional mutual fund, you could be paying 20, 30, 40, 50, 60, even higher than that per transaction, per trade. Now, you're not paying that in your 401k, but on a brokerage account, you might. With an ETF, there's a lot of providers out there that have $5 trades on ETFs, so it's a little less expensive to buy. So less expensive to buy, lower internal expenses, which means better returns, arguably, right? So when it comes to looking at the ETF mutual fund landscape, I use both personally. I like both personally. I tend to drift more towards ETFs, particularly for individual investors or and do-it-yourself investors. I just think they're more cost-effective. They're more liquid, depending on the ETF, and they cost less. So I think they're really easy to use vehicles too. So a good strategy potentially for a lot of individual investors is to own a basket of several different ETFs that invest in different markets, and that'll build you a diversified portfolio at a relatively low cost. with that being said, I mean, it's a little more complicated than just picking 3 or 4 ETFs, right? But, if you were to buy 2 or 3 ETFs and invest in, U.S. large cap and international and, maybe some small and maybe some emerging markets, and you just bought it and left it alone for the next 50 years, you'd probably be all right. Now, I think you should pay a little bit more closer attention to it than not looking at it again for the next 30, 40, 50 years. But that's not a bad strategy at all. So I just kind of want to recap a couple of these things. I'm not anti-active mutual funds. I'm skeptical on many, many, many active mutual funds. There are some good ones out there, depending on sector too. For instance, there's a lot of academic research that indicates active bond managers can do pretty well compared to their benchmarks. But I think for the individual investor, they should lean towards passive vehicles, because I think it's going to be very difficult for them to determine what is going to be a good performing active manager going forward, or analyzing their past performance, which is not super great predictor anyways, right? And when you're looking at your mutual fund and ETF portfolio, you might be looking at your 401k, which is often a pretty short list. So, there's a few checkpoints that you should, be thinking about with that, cost being one of them, and whether it's indexed or passive or active, right? And if you have questions on that, feel free to, reach out to the podcast, and, I will try to get with you on giving you some objectionable advice there. When it comes to picking an advisor and aligning yourself with their strategy on mutual funds and ETFs, I think you have to listen to the story, and the story has to make sense with what you can read and understand, right? So if it sounds too complicated to where you couldn't explain it to my 8-year-old nephew, then it's probably too complicated to work. So if I were explaining an ETF to my 8-year-old nephew, I'd simply say that there's a lot of companies out there, and it's very hard to pick which ones are going to do best, right? We might like their products, but man, what if they sell their products for not as much of a profit as other companies? So what I'd like to do is own a little bit of all the companies. And I found a nice little service that does that for us. It owns a lot of every company, right? And it does it for a really low cost. That's an ETF in little kid terms. So I hope that makes sense. I know that the investing landscape can be confusing. That's where, listening to this podcast and maybe others and reading some of the stuff I've written, which is on fsgmichigan.com. If you go to resources, there's a blog there, a lot of stuff on investing in particular and retirement. You gotta self-educate a little bit, but as you start to learn more, I think that you'll start to understand that some of these things really do make sense. Just, low cost investing is probably a pretty good route for most do-it-yourself investors. And if you're using a financial advisor, make sure their story makes sense on why they're using active, more expensive funds, if they are doing that, right? But that's going to wrap up this week's episode of Prosperity by the Pine. I am probably going to go ahead and do an episode on asset allocation, but I want to know if that's what you want to hear about as my listeners. So be sure to subscribe. Spotify, iTunes, YouTube. We are on Facebook. Like, follow, share the page, and cheers.